Today we're gonna talk about day trading using order blocks and how I use them in combination with price action. So order blocks. These are areas with significant volume orders, typically placed by large trading institutions. The key concept behind trading with order blocks involves finding specific points in the market where price has experienced a substantial upward or downward movement. A bullish order block is marked at a price level where the market has displayed a strong advance, indicating the presence of buying pressure. A bearish order block is identified when the market has undergone a sharp decline, indicating selling pressure. The fundamental principle of order block trading revolves around the notion that when the market executes a swift and substantial move, the smart money are unable to enter their entire trade at once, so they strategically leave pending orders to buy or sell within the order block zone, anticipating that the market will retrace back to the zone, allowing them to fill the remaining portion of their trading positions. A bullish order block refers to the last downward candle or series of downward candles that occur before an upward impulse in price. It serves as a support level that pushes the price higher. These order blocks signify the presence of buy orders from institutional traders and banks, essentially representing an accumulation of orders at that specific price level. A bearish order block is the last up candle or series of up candles before a downward impulse in price, and it will act as a resistance. These order blocks indicate the presence of sell orders from institutional traders, representing a distribution of orders at that particular price level. When the price eventually breaks out of an order block, it often retraces back into its range. This retracement offers you a chance to enter trades within the order block range, taking advantage of the potential market orders that are expected to be executed. A significant part of traders struggle when it comes to effectively trading these zones, and one of the key factors at play is liquidity. Liquidity is the ability to buy or sell something without causing a large price change. When a large player enters the market with a market order, it immediately removes liquidity from the market because he is demanding an immediate execution of his trade. His market order is then matched with someone who has a pending order to sell. If the market order is bigger in size than the opposing pending order, what will happen is part of the market order will be filled, but the rest will remain unfilled. So the market must move higher in order to seek out additional pending orders to fill what remains of his market order. This implies that pending orders contribute liquidity to the market, since they are the orders against which market orders are matched. These pending orders act as a buffer, providing opportunities for market orders to be executed without causing significant price disruptions. As a retail trader, your trade sizes are typically not large enough to significantly impact market prices, so you rarely need to worry about the placement and execution of your trades. But for large institutions, however, getting in and out of trades can be a big problem. Given the substantial size of the trades they enter, professional traders face the challenge of minimizing their impact on the market price. Therefore, one of their primary goals is to find areas in the market where there is ample liquidity, and these pockets of liquidity are often located at levels where retail traders have placed their stop losses. The reason why stop hunts are seen frequently in any market is down to professional traders. They are strategically placing large trades with the intention of pushing the price into the stop loss zones. When it comes to order block trading, one common rule is to consider how long the market has been away from a particular zone. It's believed that the longer the market stays away from an order block, the higher the chance of a successful trade when it eventually returns. However, this belief is actually incorrect. Think about it this way. If a bank places an order to buy or sell when the market returns to an order block, do you think they would wait around for a long time for this to happen? Actually, no. They want to act quickly to seize the opportunity. Let's compare some older order blocks with more recent zones. It's clear that trading in recently created zones tends to be more profitable than trading in zones that were created a long time ago. In simple terms, it's better to focus on recently created order blocks because they have a higher chance of resulting in a successful trade. Just imagine if you had traded these recent order blocks I marked on the chart. Each zone would have given you a decent trade. But if you had traded the older zones, the success rate is much lower. So here's the key takeaway. When the market quickly returns to an order block, there's a higher chance of getting a successful trade. On the other hand, older blocks don't usually work out well, so it's better to focus on zones that have been created recently. Another order block rule says, the stronger the move away from an order block, the higher the chance of a strong move when it eventually returns. Basically, if you mark an order block on your charts and there was a big move away from it, the likelihood of having a successful trade in that zone depends on how significant the move was. But here's the thing, the strength of the move out of the zone doesn't really determine the success of the trade. Many times, you may have placed a trade at an order block with a significant move away, only to see the market go straight through it when it returns. This also happened to me, and I used to base my entries on this idea. But the truth is, the strength of the move away doesn't necessarily indicate how strong the order block is. Even though common teachings would consider this a strong area, as you can see, the market can easily break through without stopping. So it's important to understand that the strength of the move away from an order block doesn't guarantee a successful trade, and you shouldn't solely rely on it when making trading decisions. So how do you determine which order blocks are stronger than others? The best order blocks must include a liquidity run and a break in market structure or a change in character. In this example, whoever bought when the market was down here had a lot of money at their disposal. As the trending movement increases in length, more and more people begin trading in the same direction. Look at the last downswing before the bullish order block is created. At the time of this drop, a lot of traders are beginning to go short, expecting lower prices. But in order for the market to be able to move up from here, someone needs to come into the market and buy from all the traders who are going short. And this would take a huge amount of money. Look at this obvious liquidity run, taking stops below this level and triggering new sell positions. This is the first condition. The market eventually stops falling lower and begins advancing higher, breaking above the previous lower high and marking a higher high. This is a change of character. The second condition. This bullish order block has a very high probability of giving you a successful trade, and not because it has a strong move away, but because we know whoever bought down here, creating the zone, has invested a lot of money into the market. So we first had the liquidity run, a change of character, with the order block forming between these two phases. When price returned to this area, that was your chance to enter with the smart money positions on your side. Take a look here. First we have a significant uptrend, which is very obvious. Then we have a strong, near vertical move down. This move down tells you that smart money entered the market and absorbed all the buy orders from the traders going long into the uptrend. And look at the obvious liquidity run, taking stops above this level and trapping buyers on the wrong side. And as I said, the order blocks which have the highest probability of working out successfully are the ones that trigger a break of structure or a change of character. In this case, we have a change of character, which is right here. The price broke below this previous higher low, forming a new lower low. A bearish order block created after the market has been going up for a long duration of time, and which has a liquidity clear out and a change of character has a much better chance of working out profitably. In this example, we can see a bullish order block formed after the market has been falling. We have lower lows and lower highs, and the break of structure here. A large percentage of retail traders entered into short trades at this point, which meant there was a lot of profit to be made by the banks if they came into the market and caused a reversal. When banks enter into their long trades, they consume all the sell orders coming into the market, and the price begins to increase, eventually breaking the swing high found at the top of the last move lower. So the previous break of structure was in fact a liquidity run. And this is the change of character. Both of our conditions were met. And soon after the break of the high, we see another drop taking place. This drop causes a lot of retail traders to start shorting again, believing the move higher was simply just a pullback to the downtrend. And when the market comes into contact with the order block, which was created by the first round of buying, smart money will buy again to get more trades placed in the direction of the reversal. If the banks didn't buy and the market fell below the order block, then they would be put at a loss on their positions and would have to liquidate their buy trades. In this example, we spot a bearish order block. The market had a significant move up, followed by a liquidity run that hits stops above this particular area, triggering new buy positions. After the liquidity run, the market starts declining, breaking below the previous higher low. This is the change of character. The bearish order block forms between these two phases, and this area has a high probability of being successful. When the price eventually revisits the order block, it provides you a chance to enter a short position in line with the smart money positions. Another example, the market shows a bearish order block after a significant uptrend. As the banks enter their short trades, they absorb all the buy orders in the market, causing the price to decline and eventually break the previous swing low. The previous break of structure was a liquidity run. Lower lows and lower highs are observed, and this is the change of character. This indicates that big players entered into short trades, providing a potential trade if the price returns to the order block. And as expected, a sharp drop takes place when the market revisits the order block created by the first round of selling, as smart money will sell again to reinforce the reversal. Let's analyze another trade. We had a previous downtrend, where the price consistently made lower lows and lower highs. Now pay attention to the first rally out of the zone. During this rally, we saw bullish large range candles that pushed the market significantly against the previous downward movement. And here's the key. Those bullish candles indicate that there was very little selling pressure. It's unlikely that banks were placing sell trades as the market rallied higher. The rally also managed to break the most recent swing high. I repeat, when you trade order blocks, the best advice I can give you is to make sure that the zone you're trading breaks a recent swing high or low. This break represents either a change of character or a break of structure aligning with the current trend. The reason why this change of character gives the zone a better chance of working out is partially down to the retail traders who enter into long trades on the candle which breaks the swing high. When the market breaches a high or a low, traders using technical analysis will know a possible trend change is taking place, because the majority of traders primarily use higher highs and lower lows to determine the current trend direction. Another factor to keep in mind is the impact of traders who find themselves stuck in losing trades when the market fails to make a new swing low. Let me explain. When the market is close to breaking below a swing low, breakout traders place orders in advance at that low, anticipating a breakout to happen. Once the market moves below the low and triggers their pending orders, they enter their trades. However, when the price fails to continue moving in the direction of the breakout and starts moving in the opposite direction, these breakout traders are trapped in trades that are no longer profitable. At this point, often around the order block area, these traders will decide to close their losing trades. And here's the interesting part. When these breakout traders start closing their losing trades, a significant number of buy orders come into the market. And this influx of buy orders will contribute to the upward momentum of the market. Now, most of the traders who trade order blocks try to predict where a movement will end, instead of trading in the direction of the movement itself. What these traders typically tend to do is to mark all the order blocks which the market hasn't encountered yet, and wait for the price to enter these zones before going either long or short. Usually, these zones were created a long time ago, which means they don't have a high chance of causing a reversal anyway. We talked about that. Meanwhile, as these traders wait for the market to hit these old zones, there are plenty of new zones forming in the direction of the current movement that they are ignoring. Instead of being so fixated on predicting where the entire market will reverse, you would have more success if you focus on trading order blocks that form in the direction of the most recent high or low. A new high or low in the trend, meaning a break of structure, or a BOS, is a signal that the current momentum is to the upside or downside. By trading against this momentum, you are unnecessarily putting yourself at risk of losing money because you are trying to trade against the trend. Let's take a look at an example to illustrate this point. Imagine a trader who had already marked a bearish order block on his charts before the price made a new high. However, when a bullish move occurred and a new high was made, instead of recognizing it as a signal that the price wants to continue moving higher, the trader decides to place a short trade because he believes the order block will cause a market reversal. And after reaching the marked area, the price only experiences a small drop before breaking higher again, forming another new high and creating a bullish order block in the process. And when the market returns to this area, it triggers another upward movement. By always trading in the direction of the most recent high or low, you give yourself the best opportunity to have winning trades. It's very important to recognize the current momentum and follow the direction indicated by the most recent high or low, rather than trying to predict reversals based solely on order blocks. Here's another example of an order block after a break of structure. Remember what I previously said, the quicker the price returns to the order block, the more likely you are to end up with a profitable trade. When the price moves up or down, forming a trading zone, it's possible that banks and large traders may have remaining trades that they were not able to execute during the initial movement. In such cases, these market participants may choose to take some profits off their trades and manipulate the market to return to the region where their remaining trades were intended to be placed. This allows them to enter the rest of their positions into the market. In this example, when the price shoots up, creating the order block and forming the BOS, the banks still have a few more buy trades left. To bring the price back into the trading zone, banks may take some profits from their existing buy trades. By doing so, the buy orders that were supporting the price are consumed, resulting in a downward movement. As the price falls into the region where the banks initially placed their buy trades, they leverage the new sell orders that have entered the market due to the drop. These sell orders are generated by traders on lower timeframes, who are selling in response to the price decline. And banks utilize these sell orders to facilitate the execution of the remaining buy trades they intended to enter into the market. Let's consider another instance of an order block followed by a break of structure. In this particular example, we see the price moving down, creating the order block, and forming the break of structure, the BOS. If the banks still have some sell trades remaining that were not executed when the price initially formed the order block, they will take some profits from their existing sell trades and manipulate the market to move back into the area where their trades were intended. So to entice the price to rise into the order block zone, the banks may take partial profits from their sell trades. Once the price reaches the region where the banks initially placed their first sell trades, they utilize the newly emerged buy orders from traders on lower timeframes who entered buy positions after the upward movement. These buy orders assist the bank in executing the remaining of their sell trades. You can see how the banks strategically navigate the market to maximize their trade entries while maintaining control over price movements. When I started trading order blocks, I used to enter trades by placing pending orders at the zones, which is a common approach in many trading methods. However, I discovered that using pending orders at the order blocks often resulted in losses. The market would often disregard the zone and continue moving strongly in the opposite direction, causing my trades to fail almost immediately. Many times when I first began trading these zones, I found many order blocks which met all the criteria, but when it came to trading these zones with pending orders, most of the time the market would just blow past the zone and I would almost instantly lose my trades. One way is to navigate on lower time frames and try to find another order block or a break of structure or a change of character. And this is a valid way to enter. Using candlestick patterns to enter is another method. I like to use pin bars and engulfing candles as my trigger for entering trades at order blocks. The strongest price action setup you can use in conjunction with order blocks is the engulfing candle. Engulfing candles, when found around order blocks, show you that bank traders have an interest in making the market move away from the zone. The candle itself is the result of bank traders entering into the market. The way we would have traded this is by first locating the order block on our charts. Then, after the market returns to the zone, we will switch to a lower time frame to see if an engulfing candle appears, which we can use as an entry trigger into our trades. When switching to lower time frames to look for trades, I suggest you go no lower than the 5-minute time frame. It's important to avoid going too low in time frames, such as the 1-minute chart, as it can generate many false signals. Here we are looking at an order block, and we can see an engulfing candle that appears shortly after the price entered the zone. This is your trigger for entering the trade when you see this candle form. While it's possible to enter trades using the same time frame on which the order block is identified, it's often beneficial to switch to a lower time frame. By doing so, you can reduce your risk and potentially increase your reward. If you choose to enter the market based on the engulfing candle observed on this time frame, the distance between your entry point and the stop loss level would be around 20 pips. However, if you switch to a lower chart and enter the trade based on the engulfing candle seen there, your risk would be reduced to only 10 pips. By doing so, you have effectively decreased the risk on your trade by 50%. Over a series of 10 to 20 trades, this reduction in risk can accumulate to a significant amount of money saved or earned. Furthermore, by entering the trade on lower time frames using the engulfing candle, you not only decrease your risk, but you also increase the potential gain. This is because your entry occurred right at the beginning of the downward movement. If you had traded based on the engulfing candle seen on the higher time frame, you would have entered the trade after the market had already moved down. As a result, the potential profit you could have made from the trade would have decreased. The candles which make up an engulfing pattern are directly linked to whether the zone is likely to work out or not. I want you to look at this engulfing pattern. These two candles which make up this engulfing structure. The first is a small bullish candle, and the second is this bearish engulfing candle. Whenever you see a small candlestick engulfed by a large candlestick in an order block, it's a decent indication that the market is going to move out of the order block. The first bullish candle makes retail traders think the market is going up, so they begin to buy, and when the engulfing candle shows up and pushes the market down really quickly, it has the effect of putting the buyers under intense pressure to close their positions. This is the important bit, the aspect of how time affects the actions of the traders. If the bearish engulfing candle was small and only just managed to engulf the small bullish candle, the buyers would feel less compelled to close their trades. The loss they are in is small, therefore they would be more willing to continue holding their trades. When the engulfing candle is large, the traders are faced with a much greater loss. And this is the reason these types of engulfing structures tend to work so well. As the loss for traders who have bought increases, they become more inclined to close their positions. This action of closing their losing trades can create a swift movement away from an order block. The other price action signal you can use when looking for entries into order blocks is the pin bar. Pin bars, as you already know, show a rejection is taking place in the market. usually from a support or resistance level, or recent swing highs or lows. Here's an order block. When price returns to the zone, you will then need to switch to a lower time frame to look for a pin bar that you can use as an entry trigger into your trade. As you can see, when the market enters the zone, it produces a bearish pin bar. The way you would have traded this would be to first wait for the pin bar to close. Then you place a sell trade using a market order with the stop loss placed above the high of the pin. In this example, we have a pin bar formation on the 4-hour time frame. While you could potentially trade this setup directly from the 4-hour chart, it's better to decrease the risk and increase the potential profit by scanning lower time frames for additional pin bars. Looking at the 30-minute chart, we can see another pin bar within the same order block zone. It's interesting how this pin bar is actually nested within the larger pin bar seen on the 4-hour chart. To trade this setup, you would follow the same approach as before. You would have entered a buy trade once the pin bar has closed, placing the stop loss below the low of the pin bar.